So this is cash out from Nigerian stock markets. And it's a once in a year sure strategy to pick winning stock. So even though in between, I'm going to share some other insights with you, but the major part of this webinar will be centered around the type of stock you should be buying by now. And I said something that if you miss this webinar or you miss this opportunity, you might have to wait till next year. And I will tell you why you need to take advantage of this opportunity. So let's look at the things you're going to learn before we get started. So these are the things you're going to learn at the end of this webinar. First one, I'm going to show you how to analyze Nigerian stock market itself and why it's so important. So many of us jump on different stocks. Maybe if you just funded your account or you have some spare cash you want to buy, and then immediately you go to the market to start buying without understanding whether it's actually the right time to buy stock or not. So I will discuss this is very important. You don't just jump into the market to buy any random stock. You need to know whether it's actually is it actually the right time to buy stock or not. Because if you jump into the stock market at the wrong time, you can actually lose money. So you can buy the right stock at the wrong time and lose money. And even if you buy the right stock, like I said, as long as you're buying them at the wrong time, you can lose money. That's why many of us will say, I've done my analysis, I did my due diligence, but why are stocks still going down despite all the whole thing? I'm going to show you that single thing that you have ignored for a long time. So that's why I had to bring this, how to analyze NGS market index and why it's so important. Number two, I will also share the reason why August, September is an important period in the stock market, especially in the Nigerian stock markets. Why it's so crucial that you don't miss the opportunity within this particular period in the market. And then I will share why financial statement isn't entirely the best. This is what many of us so rely on. Some of us are so stocked. We are so hooked and so attached to financial statement that at the end of the day, we see that it's not even working. We are so used to revenue, P ratio, all those big language, complex, discounted cash flow. And after doing those analyses, we are still not making money in the market. Why? I will share. I'm not saying financial statement is not okay, but I will tell you why it's entirely not the best. Then I will then tell you my preferred data, what I use to forecast the market. Then we'll then discuss the two strategies to trade stocks that always make money. The two strategies to trade stocks that always make money. In this webinar, I have a combination of the new members and also the existing members of my community and all that. So I'm going to take into account both. And then we'll look at my favorite dividend growth stocks to buy. This is actually the reason why we're actually having this webinar, because I don't host webinar without mentioning stocks to buy. If you've been part of my webinar for the last 1 to 2 years, even from January, you will see that anytime I host a webinar, I would always tell you, go buy this stock, go buy this stock, go buy this stock. And majority of the stocks that I've recommended so far, at least, we say that over 70 to 80% of those stocks have actually done well. And we don't just tell them to go buy the stock. I give them reasons. And my reasons are actually divided into three. First one, fundamental reasons why the stock is okay, which is where you would know what to buy. Then I'll tell them sentiment behind that stock, whether investors love the company or not. And then the other side is technical reason, which is timing, whether it's actually the best time to buy the stock or not. Then we'll then move to the market and execute our buy order. And then I will then analyze each of the stocks and my recommended entries for each of these company stock. So these are the things you're going to learn. At the end of this webinar, you are going home with, you're going to learn a new thing that would help you take better decision, not just trade decision, but also investment decision in the market. So let's get started. How to analyze NGS. What is NGS? NGS is Nigerian Stock Exchange Index. I remember then when we were small, when we started getting used to the market, you would always hear Nigerian All Share Index went up by 0.5% to probably touch 35 basis points. Many of us don't understand what it means. We would always hear that Nigerian stock. So in our head, like, it doesn't matter. Should I follow the Nigerian market? Is it necessary for me to understand NGS? Then I'm here to tell you that yes, that's number one thing. If you have not been following NGS, then majority of the mistake you're making in the market might actually be connected to this, and I will tell you why. What is NGS? NGS represents all the company stock traded on the floor of Nigerian Stock Exchange. It helps you understand, note, market sentiments at every point in time. It's supposed to be at every point in time. Sorry for that. which can be bullish or bearish. Why should I follow NGS index? Why is it important? This is the reason NGS index is very important. Because NGS index is comprised of all the companies in the market, from oil and gas to insurance to banking to consumer goods, because it covers all the companies listed in Nigerian stock market. It gives you an idea whether the sentiment in the market is bullish or bearish. What does it mean? If today you listen to news, or maybe you follow Arise TV or Bloomberg or Business Day, and you heard that, oh, Nigerian oil share index inched up or went up by 0.54%. What does that mean? Have you taken your time to ask yourself what that means? It has its own implication. Now, when NGS goes up, what does that mean? It means that a larger number of companies recorded increase in their share price compared to the companies that recorded decrease. That's what it means. It means that if there are over 223 companies listed in the market, maybe an average of 90 company stock recorded increase in share price, and then maybe an average of 30 recorded a decrease in share price. That is what makes NGS goes up. Now, if NGS dips, it means that a larger number of companies recorded decrease in share price, and then while a smaller number recorded increase. So when NGS goes up and down, it doesn't mean it's all the companies that are listed. So if tomorrow they tell you the Nigerian Stock Exchange recorded 5.5% gain today, that means a larger number of stocks recorded more gain than loss. And what does that mean? It means that buyers were more bullish. Sentiment was positive. People bought more stocks than they sold, because when buyers are more than sellers, or when buying volume is more than selling volume, then price naturally should go up. That's what it means. So why should I follow this? The reason is very simple. It's because at least 60 to 70% of the move on your stock price, they are largely tied to NGS markets. So no matter how good or how sound you are in terms of analyzing stock, if the overall market sentiment is negative, your stock will go down. That's the significance of understanding NGS. If the overall market is going up, your stock will likely go up. Look at the last bullish run we had. You will notice one thing. Both the good and bad stock, both stock with good fundamentals and stock without good fundamentals, all went up. That's the effect when the overall market is going up. So you would like to make more money in Nigerian stock market if you are able to capture that moment when Nigerian stock market is about to rally higher. Because at that point, the tendency that your stock will go up is high. It's like what we call a bandwagon effect. So because the overall sentiment that is driving the market is going up, it's the tendency that your stock will go up will probably increase. That's exactly how it works. So if you jump into buy stock when when the overall sentiment around the market is negative, your stock will likely go down. That is why if you carry out analysis on a stock and eventually you see that the stock is still going down, despite the fact that you've done your fair value calculation, everything is telling you, oh, this stock is undervalued. But when you buy, what happened? The market, this price still goes down. It's because you have ignored NGS. NGS is so crucial because NGS is like a weight that will pull all the stock. So if you buy a good stock at the wrong time, you will likely lose money. What is that wrong time? That wrong time is when NGS itself is about to go down. So how do we know whether NGS itself is positive or negative? So I like to buy stocks when sentiment that is driving the market is positive. And I will tell you a simple tool I use to gauge sentiment in the market. And again, when I notice that the NGS market is already at the top, that means the market has so rallied to the extent that I feel that buying volume or buying strength is already exhausted. I start reducing my portfolio. So I don't have to wait for the market to crash before I start selling. These are the tricks that I've used to make sure I manage my portfolio properly. Now, I have a chart right here that I used to follow the NGS market. This is TradingView, and here the symbol is ASI. Now, this is the monthly chart of NGS. What do I do? First, I like to look at the broad picture. I like to look at where NGS is coming from and where it's going to. So here we'll see that the market has been largely bullish since COVID, which is March 2020. You can see how NGS has rallied from a low of 21,000 basis points to reach this top level. This is for long-term investor. Now, for me that is trading, how do I know whether the market is largely bullish or bearish. What I like to do is very simple for me. I like to go down to my daily charts. I use the daily charts to check sentiment behind the market. And the single tool I use to know that is what I call my 20 days moving average. What is 20 days moving average? It's an average that measures the price of an asset in the last 20 days, which is like 1 month. Now, if the market is trading above the 20 days moving average, it's assumed that there's so much strength in the market. It means that the bullish sentiment in market is very strong. It means that buyers are snapping off stock. Now, if the price is trading below the 20 days moving average, it means the sentiment is very, very weak. So let's go back to when we started our bull run initially. This is November. You could see that during November, NGS itself, look at it, all share index, cross the 20 days moving average. This marks the beginning of a strong bullish run. For someone that started buying stock, if you notice in the market from November, the market started rallying higher. A lot of stocks started picking up because NGS is not a stock. NGS is made up of different companies. So notice that during November, a lot of stocks started picking up. What happened? It was because the NGS crossed the 20 days moving average, and this actually marked the beginning of a bull run. So for someone that is very, very smart, this would have been the best time to start buying into stock. Now, it was within this period that I noticed certain stock. Let me give you an example. It was within this period that I noticed stock like corn oil. Many of us started jumping into corn oil when we saw that corn oil was already trading for 90 naira, 100 naira. But some of us that are smart actually jumped into corn oil when corn oil was selling for around 24, 25 naira. And I will tell you why. Now, like I told you, the best time to buy a stock is when NGS itself has just crossed into a bull market. That means the bull run has just started. So if you want to capture the biggest move, the biggest opportunity in the market, only buy stock for trading when the market bull is about to start. That means you're buying at the beginning of a bullish run. So during that period, I noticed that because that period was also coincided with when we had the fuel scarcity, that was before the subsidy removal. So I saw how the fuel scarcity had lasted, and fuel scarcity had always been bullish for downstream companies. So it was during that period that I noticed corn oil. And then corn oil, I started buying corn oil around November 2022. You can see corn oil was selling for 25, between 25, 27 or thereabout. And then we saw huge breakouts on corn oil. So this was the first time I started buying into corn oil. Why did I buy into corn oil? I bought into corn oil, number one, when I noticed that fuel scarcity, number one. Number two, I bought into corn oil because I saw that NGS has just entered a new bull run. And how did I know that? Because before November, we've seen how the market has staged some pullback. Let me go back to period before. Look at it here. You can see that between June to October, November, NGS had been on a downtrend. And notice what I said. When the market is selling below the 20 days, now some of us jumped in to start buying stock within this period because we've done our analysis. We believe so much that this stock will rally higher. And eventually, you can see here, most of the stock went down. So when overall market is negative, you don't jump in to buy stock. If you want to buy stock, you have to be extremely careful because the overall market at that point is telling you that this market is down. So you don't against the market. You don't go into the market and expect the market to do what you want. No, rather you push the market. What are you doing right now? The market tells you that I'm selling, you stay off. But if the market tells you that I'm buying, what do? You jump on the market. So when I saw that cross, you can see during that November period, it marked the best time. And one of the advantage of buying stock at the beginning of the bull run, when the overall market is sensitive, is that there's going to be the weight of the push that's going to drive other stock would also have your stock go up in the same period. So corn oil rallied from that 25 naira region. You can see right here, it rallied from 25 naira region to touch 40.45. Now, when I saw corn oil at 40.45, I was in profit. But I saw another opportunity in corn oil. Immediately, I hosted a webinar with everybody. I said, we are going to buy corn oil again. So some people might now say, don't you think corn oil is already expensive at 45 naira? Because I see people send me that kind of question. They always think that their definition of a stock being expensive is the price. That is a lie. When you want to compare two stock, the last thing you should ever do in the market is to think that because a stock is selling at a high price, that makes it expensive. A stock might be selling for 45 naira and it will still be cheaper than another stock that is selling for 50 kobo. That's the truth I want to establish right now. What makes the 45 naira stock cheaper than 50 kobo? Because when you go by normal senses, you're like, why say that? Is 50 kobo not cheap? If 50 kobo not allow me to buy larger units, you don't look at stock like that. What makes a stock cheap compared to others is when the growth rate of that company is faster or higher than the other stock. Corn oil at 45 naira was still cheap within that period. I told everybody, go buy corn oil. Many of the members were actually in this community that they are listening to this webinar right now. Go buy corn oil. And corn oil broke out of 45 naira and went, you can see where corn oil went up to. Now, it was after this period that subsidy was removed and that contributed to the huge rally on corn oil. What am I saying in essence? The majority of the move on your stock price, at least 70 to 80% of the factor that would most likely drive your share price upward is the sentiment behind the market and not the company itself. So if you want to understand what moves your stock, 80 or 70 to 80% of the factors, they are tied to NGS as a whole. 20% is tied to news around the company sector that company is. Then just less than 10% is connected to financial statements. So if you are too used to using financial statement to forecast company share price, I tell you, except you are a long-term investor, but when it comes to trading the stock market for capital appreciation, this is not, financial statement is actually not what you should focus on, even though it helps. I use financial statement for confirmation. So what am I saying in essence? When NGS broke out of 20 days, look at the huge rally. Go check most of the stock. Look at Fidelity Bank. Majority of the banking stock that you missed, they actually started their rally from November. Now, an opportunity that showed itself was when NGS retreated. You can see around March, we saw NGS pull back a little bit. Many people would have started selling right here out of fear. Now, where did the next opportunity came from? Look at the next opportunity. NGS broke out again in May. On a single day, NGS did 5%. So if you did not notice that, you'll probably be asking, this is normal thing I'm used to. After all, I just lost money. And then you will sit there not knowing the best time to buy. So from there, you can see how NGS rallied from 55,000 to reach this level. Now, if you watch the market in the last 2 weeks, you will notice that the market has been quiet. You would notice that the reason is very simple. You can see what is happening at the top right here. NGS is actually looking overbought. So at this stage, we call it what I call distribution stage. There are 4 stages in a life cycle of a stock on the stock market. First one is what we call accumulation stage, when the stock is trading within range. Second stage is when the stock enters what we call its breakout stage or advanced stage. That advanced stage is when the stock starts rallying higher. After an advanced stage, the stock goes into what we call distribution. Distribution is what we call overbought. It's already high. Nobody. So at this distribution point, a lot of smart investors are taking profit. And then after distribution, what should you expect? Decline stage. So it always moves, and from decline stage, it goes into accumulation again. That's how it continues its cycle. So the question for you now is, you need to know the stage that the NSE or share index is. That is very critical, because if you don't understand the stage and you think you can just buy stock at any point in time, you will lose money, because timing matters a lot in the market. Now, look at what is happening right now. NGS right now is consolidating at this top. So you will notice that we've not seen any major move. A lot of stock have been quiet. The reason is NGS is already at distribution stage. So what comes after distribution? The moment price breaks below this 20 days moving average, then we are actually in a decline stage. It's going to be a sell-off. There's going to be a sell-off. Would you want to start buying a stock during sell-off? No. Does it mean I shouldn't buy a stock? Sure, you can buy, but when you buy a stock during sell-off, you don't go in with all your money. You go in with a certain percentage, because the sentiment in that market right now is negative. You can see the stages and what to do at every point in time. If you want to buy stock at this stage, what do? You go in bit by bit, or you can even stay off. But the moment you notice that the market has broken the 20 days upward, you buy. So we will now ask, what happens when the market is down? Should I wait or should I not buy any stock? The truth is that you actually make more money in stock when you are patient. You make more money in the stock market when you are patient. Don't think that is when you have money, you fund your account. You must not always buy stock every point in time. Sometimes keeping your money as cash balance might even be more profitable than buying stock. Everything boils down to timing. At this stage, some of us are already keeping our money as cash. At this stage, most of my money in the stock market are already as cash. Why? Because it's a risk for me at this point. So even though I still have exposure to some stocks, but I need to be very careful because what happened? The market may be down. And when we go to the fundamental side of the market, I'm going to explain. Look at the result released so far in the market. They have not actually met expectation. In short, exchange has pulled a lot of companies down. So this for me is a risk. There is no major news driving the market. So that means you have to be very careful. You have to be extra cautious at this point. Now, I'm not saying the market must come down because I've already told them in the community that when the market breaks out of 66,000 basis points, then it means there are fresh buyers in the market, which means the bull run still continues. But as long as the market is still within this range, I'm not buying. Everybody needs to be very careful right now because if you buy this stage, what if the market tanks? Now, it doesn't mean that if the market tanks, you have done the wrong thing. You've done the right thing. You've picked the right stock. But the problem is that the sentiment in the market, which is biggest of all, which is the biggest influencer of your stock price, is negative. That's why your stock is down. So when sentiment in the market is negative, you pull back. Now, when you pull back, that is the best time to buy as an investor. So you can see that trading and investing are not the same. An investor buys stock when prices are down, but a trader buys stock when prices are about to pick up. Now, I'm not saying that a trader will not buy when prices are down, but you need to be very careful because when you average down, it's good to average down on a stock that has found bottom. Don't just average down on a stock because the price is going down, because you might end up buying into a falling knife. In the stock market, there are stocks that are like falling knife. There are stocks that are like bouncing ball. The bouncing balls are those ones that has the probability of bouncing back when you know that anytime they dip, they will bounce back. The falling knife are the ones that when they go down, you don't know whether they are going to come up again and you might end up losing. So my advice is when the market is down, it's good for you to focus on building your investment portfolio at that point. Leave trading. So what you should do, you then switch to your investment portfolio and see how to load up more stock because the more you buy your dividend stocks at lower price, then your yield will be a lot more higher. And if your yield is higher, then your return on investment will be higher. Now, the moment stock price start picking up, you stop buying into your investment, you then move into your trading portfolio and see how to take advantage of the rally. So you can see that whether the market is up or down, there would always be what you always know what to do, whether to switch to investment or switch to trading. So that's why it's important for you to analyze NGS because majority of your stock prices they are influenced by NGS. Let me give an example of what NGS is. For some of us, I might be asking, what is this NGS you're talking about? What does it mean? Now, if I go to listed company, this NGS website, Nigerian Stock Exchange website. Now, this is what NGS means. Look at all these companies here. In each of this sector, there are companies listed. So imagine the stock price of all the companies listed in agri, conglomerate, construction, consumer goods, financial service, healthcare, ICT. Imagine putting all these things together. And when you put all of them together, they now help you form sentiments in the market. And when they form sentiments in the market, you are able to tell whether the market is going up or down. You can see NGS index right now. So this is what you need to follow because this NGS index will help you understand what everybody is doing. Now, because I wouldn't advise you to be following the market on a daily basis, because some of us will ask, does it mean that if NGS close up, let's say 0.24, that everybody is buying, and then when it goes down, no. I don't want to sit in front of my system monitoring NGS on a daily basis. So the only thing I use is to look at the 20 days moving average. So you can see that as long as price is above the 20 days moving average, even though we had a dip at some point, overall, the market still went up. Now, if the price is below, even though we still had a rally at some point, what happened? The market still went down. So what 20 days moving average does for you is it helps you separate the bull and the bear. It helps you know when everybody is buying. Look at the strength from November. If you had bought stock from November, the tendency that your stock will go up is very high. So you buy stock when the probability that your stock price will go up is high. And that happens when NGS is trading above the 20 days moving average. I can go back to show you different period. You can see here. So always understand the sentiment driving stock, because this sentiment will also affect your stock, whether it's good or bad. So that is very key for us to understand. So that's one part. Now, the second part is, why should I accumulate stocks between August and September? Why is it very important? Why? Because I've always been preaching August-September period. This is the reason. I said majority of the companies listed on the floor of the Nigerian Stock Exchange would have released their half-year results, which should help you spot the few ones that are already on track to beat their previous year earnings. There is one thing about half-year results that many of us don't know. You really don't have to wait till end of the year before you will know stocks that are actually on track to beat their previous year. Half-year results alone will tell you that. And half-year results together with what I call TTM. TTM is trailing 12 months. It's trailing 12 months. Let me give an example of what trailing 12 months is. If a company, normally, a company's full year is first quarter, second quarter, third quarter, and final quarter. So January to December, right? Now, TTM is last 4 quarter, and last 4 quarter is not, it's not supposed to be January to December. If a company is in its first quarter, let's say we're in March, and the company just released its first quarter results, its trailing 12 months will be the last 4 quarter. And last 4 quarter will be first quarter 2023 plus fourth quarter 2022 plus third quarter 2023 and then plus second quarter 2022. Let me take that again. First quarter 2023, fourth quarter 2022, then third quarter 2022, and then second quarter 2022. That's the last four. You will start counting from the recent quarter. That's what we call trailing 12 months. So many of us don't have to wait till the end of the year before we're able to spot companies that are on track to beat their previous year. Once a company's Q2 result is out, we'll count last 4 quarter backward. Let me show an example. Skyway Aviation. I remember in the community, I mentioned Skyway Aviation, but we couldn't buy Skyway because like the stock was scarce. Skyway was selling for 5 naira when I spotted them, and I even posted in our group. And I told them the Q1 results of Skyway alone, you can check, you can verify. The Q1 result of Skyway already covers almost 90% of its full year in 2022. So if you calculate last 4 quarter for Skyway, it already showed that this company is already beating full year results. Just in 2021, nobody, in short, people were not even selling Skyway. Skyway was scarce. And Skyway had moved from 5 naira to almost high of 18 to 20 naira. And I told them that because of the industry that the company is, and for the fact that NACO was already selling above 13 to 15 naira, it already showed that Skyway would most likely catch up. Go check the price of Skyway. Now, what am I trying to say in essence? When you follow trailing 12 months, you can easily tell the companies that are on track to beat their previous year. So August and September, majority of the companies in the market would have released their second quarter results. So, and that second quarter is almost half year. So what I do is I will then check half year 2023 plus half year 2022. So what I do is I will then do second quarter 2022, 2023 plus first quarter 2023, then fourth quarter 2022 plus third quarter 2020. That's trailing 12 months. If you can find companies that are already beating their previous year, that second year result will tell you that. So that is why August, September is so critical in the market. Meaning that between August, September, and maybe early October, you are already positioning yourself bit by bit on this kind of companies. Now, it's not every company that you're going to buy. So I'm not going to tell you the type of company to focus on. Now, the type of company to focus on are companies that are actually going to attract institutional attention. So you're not looking for any company because many companies will beat their previous year. But I am trying to look for those ones that will attract institutional attention. There is nothing like buying a stock that the big boys are buying. It's just like buying a stock that fund managers, stockbrokers are going to be jumping over themselves to buy. It's the kind of stock we want to buy. Imagine you as a fund manager, you are dumping 10 million into the market, you're dumping 100 million in stock. Literally, majority of them go for dividend stock. So what are we doing? I will now go for, look at it, I said these are stocks that are likely going to declare payouts more, they're going to pay out more dividends, declare or pay out more dividend to their shareholders as a result of increased revenue, earnings, and I call them high-yielding dividend growth stock. These are the kind of stock that we're looking for. What are dividend growth stock? We have dividend stock in the market. These ones, they pay you dividend. In short, one of the things that makes them attractive is that regular annual payout. Now we have growth stock. This was, they are there for capital appreciation. Many of them don't pay dividend. Now imagine that you are now bringing stocks that has both the feature of dividend and growth stock in one place. These are the hottest stocks to buy between August, September, and early October. Why did I say they are hot? Because they are already on track to beat their previous year. And their financial statement has already shown that these companies have generated higher revenue, net income, and earnings per share in first quarter, second quarter. And when you calculate the last 4 quarters, it's far higher than previous full year. And you know that this kind of companies, anytime they report increased profit, it always comes with increased dividend payout. That's the kind of company we want to buy. And why did I call them dividend stock? Because they pay dividends. Why did I call them growth stock? Because they also have the attribute of capital appreciation. So what is going to attract institutions to this kind of company is because they pay dividends. And insurance companies love dividend stock because they can't expect me to dump 50M, 100M in the company that doesn't pay dividend. That's why it's as if when it's close to dividend payment period, closing date, this kind of stocks start rallying higher because everybody wants to jump over themselves. So I call them high yielding. The reason they are high yielding is because they are actually one of the highest yielding stocks in the market. That means their dividend yield is actually high compared to others. So imagine a stock being an high yielding dividend stock and also has attributes of a growth stock. So why are we buying them? We are not buying them, although it's optional. We are not buying them because we want to collect dividend. No, we are buying them because we know that when we take position in this kind of company between now and next year, by the time they declare their third quarter result, final quarter result, they will start attracting positive sentiment. And that positive sentiment leads to what? Increase in share price. And then once they announce that dividend for 2020, maybe dividend for 2023 and 2024, and they are getting close to their closing date, as people are rushing to buy them, that's where we're going to sell them back. So meaning that we would have enjoyed reasonable capital appreciation between October to when we're going to sell them next year. Kind of stock we want to buy right now. And I will show you how I do this analysis from top to bottom. So it's not like I'm going to guess or whatever. And we are going to dive into each of these companies' financial statements. Now, guess what again? We are not just interested in financial statement telling us that, oh, this company have declared good results, then we want to buy them. No, we are looking for one important thing. And if I see that a stock is not driven by this key factor, I might probably not even buy that stock at all, because I don't want financial statements to be the only thing that will tell me that this stock is a good buy. And I told you earlier, financial statement is not entirely the best when it comes to forecasting. Start off, a lot of companies that declared good results in Q1. What happened? Many of us jump into the company stock thinking that Q2 will be better. What happened in Q2? They went down. What does that tell you? It means that financial statement in itself is a lagging indicator. It tells you what happened in the past. It does not forecast the future. So here, this is what you should do. I said why you shouldn't invest with financial statement, but focus on macroeconomic numbers. This is what you need to forecast stock prices. They are the financial statements are largely historical. They don't tell you what will happen. Hence, I back my trade up with economic data. What are economic data? I said the best stock should be well supported by recent macroeconomic data. What are economic data? Economic data helps you to foretell what will happen in the future. What's the biggest talk on town? What's the most popular macro data that everybody's talking about today? Exchange rates. Macro data like exchange rates, oil price, interest rates, government bond yield, government policy. These are the things that tells you companies that will do well, not financial statements. Financial statements should only be for confirmation. Don't use financial statement to be forecasting company that will share price that will go up. Use financial statement to confirm if your analysis of that company based on sector events. Let me share an example. Around January, February, I dropped one stock and I used simple macro data, which is inflation, NASCOM. Many of us that actually joined me early this year, you probably have gotten that stock. NASCOM was selling for 10 naira. And I didn't tell them to go buy NASCOM because NASCOM declared good results. No. I told them, go and buy NASCOM because NASCOM will be well supported by inflation. NASCOM is in the food sector. And inflation is one of the key macro data. And companies that benefit from inflation are companies that sell inelastic products, meaning that when they increase their price, it doesn't affect demand. Why? Because the product they sell, they are inelastic. And if a company has pricing power, they are able to increase margin. And they're not just increasing margin to make profit, they are also increasing margin to recover or to cover up for increasing costs and also reward shareholders. One of the core things that was driving NASCOM was tomato. Many of us, tomato was scarce at some point in time. And NASCOM sells tomato in sachet. I looked at the macro data. I looked at the sector and I saw that NASCOM would benefit. When NASCOM released its first quarter results, it was a clear winner. Profit went up by 80%. So what did I use financial statement to do? I used it to confirm my analysis. I did not say go buy NASCOM because they released. Because if you go buy NASCOM after that financial statement, you must have lost the opportunity. So macroeconomic data helps you to get in ahead of others. So when others are jumping over themselves and the company has released good results, the smart guys will be selling back. So when financial results are being released, you know what happened? The big guys are selling back to you. You would think that you're buying into a good stock, or just release good results, but you didn't know that others are using you to make profit. The smart ones have already used macro data to jump into the stock early enough. So you that are jumping into the stock now, what happened? The share price, haven't you noticed multiple times where a company will release its result and you just expect of 1 week, the share price will start going down. And you're like, what happened? I thought the reason is because the numbers that you see here have already been factored into that share price. So people have already forecasted that number ahead. And what did they use? They use macro data. So shift your mindset away from financial statements. Use financial statements to confirm. When I saw NASCOM results, it was very impressive. That gave me confidence to hold on NASCOM more. Look at NASCOM Q2 results. NASCOM is selling for 14 naira. And what is supporting it? Macroeconomic data. It's how to forecast company. It's how to trade stock. That's how to get into a stock ahead of others. Not necessarily waiting for. If you wait for financial statements, you will get in late. And besides, financial statement will only tell you what happened in the past. So what am I looking for? I am looking for stocks that are actually going to attract corporate attention because they are high yield dividend stock, dividend growth stock, and are well supported by macro data. That's the point. Meaning that with macro data, I can tell that even though this company has released good numbers Q1, Q2, I am confident that this company will release good numbers in Q3 and Q4 because the macro data supporting their performance is still intact. I don't need to wait for, I don't even need to punch calculator or punch numbers or start forecasting. No, the data are intact to tell me that, and I will prove you with what I'm going to share. We're going to dive into each of the company financial statement, and you'll be so surprised what I'm going to share with you. How macro data alone can help you stay put on a company stock. Now, look at this here. Macroeconomic concern right now is exchange rates. Many of us have seen it. USD has moved from an official rate of 460 to reach a high of 880 before retreating in the Nigerian forex market. Look at the recent result that came out. A lot of companies were battered. FX loss, unrealized gain, FX loss, unrealized gain, FX loss, unrealized gain, FX loss, unrealized gain, FX loss, blah, 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 blah. If you have relied entirely on financial statements, thinking that Q2 result will come out, this guy would have told you, no, step back. I'm in charge. I'm in charge. If you don't respect me, if you don't listen to what I'm saying, you will get burnt. I'm in charge. And look at the thing that's actually affecting the companies. Stocks that are exposed to US dollar denominated loan and payable, they were red. They are red zones. They are red zones. Because a lot of companies now are looking at recovering their costs. A lot of companies are battling with unrealized loss. A lot of companies that are exposed to foreign exchange denominated loans, they're looking for a way to pay back because the naira equivalent of their USD loan is higher. Some of them that are exposed to trade payables. Look at Unilever results. Look at Cadbury. Now, I even did a comparison between Unilever and Cadbury. Those that joined my community, I told them plainly that I would sell Unilever, but I will not sell Cadbury. So because there are different types of exchange rate gain and loss, I went deeper into their financial statement. I told them the effect of exchange rate on Unilever for me is concerning, is disturbing. Why? Because that exchange rate did not only hit their finance costs, it actually hit their cost of sales. That means they actually need dollar to import raw materials. It was a problem. The one that affected Cadbury only affected their exposure to USD. So if exchange rate is a bit stable somehow, yes, they will pay more as cost, but the fair value of their USD loan will be a bit stabilized. But for Unilever, because they need that USD to import, they are largely dependent. So that accounted for the reason, if you watch, we've seen a significant recovery on Cadbury stock. But on Unilever, it's still a bit down. But if exchange is well managed, and I told them again that I am watching exchange, there's a level exchange rate we get to, everybody get out of stock immediately. But we're still watching. Because if exchange rate get to that level, then that might be a problem. So while others are paying attention to financial statements, we are looking at exchange rate trend. And let me show you something. I pay attention to charts a lot when it comes to analyzing macro data. So this is USD Nigerian exchange rates. You can see at this point, let me drill down to, let me use the official rates before that now unification. All right, this is it here. Now, Nigeria is exposed to exchange rates. You can see as far back as 1998, dollar was selling for almost 82 naira. Look at where we are right now. We're going to delve a little bit and tell you some important thing about exchange rate. For the purpose of those that are joining us for the first time, I want to expose your mind to certain things that you may not know about exchange rates. And I'll tell you what to do. So let me just divert a little bit into exchange rate. I have a course on exchange rate to income costs. So this is exchange rates. You can see how the rate has been rallying higher. Now, this was the period where CBN unified rates. It was later on they started telling us that it's not unification, blah, blah, blah. That's another thing entirely. Now, you can see the increase from 462 to a high of almost 760. So this was the single thing that battered a lot of company financial statements. Now, the question is, will this rate come down or will it keep rallying higher? And I've been saying this as long as I've started talking to people about stock investments, having a WhatsApp group, that exchange rate will keep going up. Exchange rate will keep going up. Not because I don't like Nigeria, but the simple thing is that the data tells me that rate will keep going up. There are two types of dollars in Nigeria. Many of us will be surprised. Like I said, some of us are joining us for the first time. So there are certain things you might be hearing for the first time, which I think would help you. There are two types of dollar in Nigeria. We have the hot money, hot dollar, which you call foreign portfolio investments. And then we have the patient dollar, which is what you call the foreign direct investments. Foreign portfolio investment and foreign direct investment, they are not the same. Foreign direct investments, when this type of dollar comes into your economy, they are coming to stay. They are coming to create job. They are coming to develop your economy. Imagine a company like Amazon saying that, oh, or people, we're coming to build factory, iPhone factory at Agbara in Ogun State. Do you know what that means for Nigeria economy? That's patient dollar. That's foreign direct investments. These ones are coming to develop your economy. When this type of dollar, when they boost your reserve, we should be happy because they are coming to stay for as long as 5 years, 10 years, 15 years, 20 years, and they will help you to shore up your reserve. That's foreign direct investment. And it takes government that is sincere come up with a policy to attract this type of dollar. Investors don't just come into an economy with foreign direct investment to stay for a long time. They must have assessed your environment. And Nigeria do not have that environment yet. We don't have the infrastructure to attract that kind of dollar. The easiest one that our CBN is busy pursuing, and they will come online, they will come on air telling us they are fighting inflation, is hot money. What is hot money? Foreign portfolio investors are not coming to your economy to develop your market. They are not coming to develop your country. They are coming to make more money. Instead of money, they are channeling into the stock market, they are channeling into the bond market, they are channeling into, they want to make more money for themselves. And what are they looking for? Higher interest rates. And what do you need to attract this kind of money? Increase in interest rates. If CBN is telling you that they have been increasing interest rates to fight inflation, that's the biggest lie. I wonder who is telling, I don't know whether someone is not telling them the truth, because the gospel truth, the simple underground truth that you don't know, which going forward, if you have access to CBN, maybe you should find a way. I like to say this because I don't know who I'm talking to. I don't know where you are. I don't know your kind of network, but I will say this. CBN has been telling us lies that they're using interest rate to fight inflation. Rather, CBN is using interest rate to encourage, to entice foreign portfolio investors because they know that if they reduce interest rates, these guys will run away. And when they run away, where do we get the dollar to sustain or to help to cushion the demand so that my exchange will be stabilized? No. I'm going to show you an evidence to prove that. Look at Business Day. Many of us know Business Day very well. It's one of the reputable newspaper. Look at this headline. On June 26th, look at the kind of battle that our Nigerian government is battling. Nigerian torn between low interest rates, strong naira, as foreigners swear. And I'm going to read this to prove. So that it won't look to you as if maybe I'm just saying it or I'm assuming. I've been saying it for a long time. So when I read this on Business Day, I like to keep this to prove to everyone what CBN is doing. You can see the dates, June 26, 2023. So let's go on. Look at this here. African biggest economy is once again torn between achieving low interest rates and raising them to attract, you can see, raising them to attract the badly needed foreign inflows needed to support the naira. Meaning the CBN need to increase that rate. Why do you need to increase rates? And we know the effect of increasing rates. You are making small businesses. You're making the cost of doing business very difficult. These guys cannot survive. How do you think they're going to provide employment? So the only thing they can do is to increase interest rate at the detriment of small business. Now, let's go on here. I'm just trying to skip a little bit so that I won't take our time here. President Tinubu has set out to reduce interest rate. This was this guy's plan earlier, before this recent rate hike. This was this plan earlier, which he deems to be too high for business. You can see here for businesses. Now, look at bonds. But foreigners say the rate on Naira bond will need to be at least double before they bring in dollars needed to grease the newly. Can you just imagine? He says the president is saying this rate is high, it's killing our business. But we don't have any choice because we need the dollar too to sustain exchange rates. Now, look at this again. I'll go down a little bit. Now, raising interest rates will therefore not be as straightforward as debt servicing costs will be. Look at this here. That means the government need to spend this, blah, 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 blah. Now, look at where I'm coming in again. Foreign investors say the negative real return, which arise from interest rate lower than inflation, is deterrent to new dollar inflow. That means if you want me to bring my dollar to your country, you have to increase your interest rate because the interest rate in your economy right now, compared to 22% plus inflation, is giving me a negative return. Negative return is when your return on investment is less than inflation. So the negative return also reduces the competitive of our Naira assets. Just, you can read on. I can drop this link in the comment section so I don't spend time. But the whole idea is that I want you to see how that CBN increase in interest rates, they are not doing that to fight inflation. As inflation numbers come down since last year with the whole multiple? No. Why? Because the problem of Nigerian inflation is structural problem. We should not be copying the US Fed, thinking that by US Fed, by increasing interest rate in the US Fed, and then their inflation is able to come down from 9% last year up to then it will work here. No, you don't use inflation, you don't use interest rate to address inflation in an economy where unemployment is high. The US unemployment rate is very low. That's why they can use inflation. You can use interest rate, to fight inflation. Nigerian unemployment rate is so high that you can't use it. Forget this new modeling that they did that is telling us that it's down 4%. I don't even want to go there because this is not the time to talk about politics here. But I need us to see what CBN is doing. Why? What is that underground reason for the multiple rate hike? Is because they want to sustain dollar inflow from foreign portfolio investor. If these guys decide to take their money off, because this is hot dollar, where are we going to get our dollar? So anytime CBN is saying that our reserve has increased, don't get excited. Probe the source of that increase. If the source of the increase is coming from foreign direct investment, very good. That's the one I'm excited about. Because when I see that more companies are coming to establish in Nigeria, they have more dollar, but not the news of companies exiting. See GSK. So the only thing they can do right now to sustain dollar inflow is to increase interest rates. So that's what I've been doing. But has it been working? No. The reason it's not been working is simple: demand and supply. The demand for dollar is so high in Nigeria. The backlog with banks are so high. The supply is low. CBN needs to fight supply and stop fighting demand. You can't fight demand. Simple, you can't, no government has succeeded in fighting demand. Rather, work on encouraging supply, which is what I've shared multiple times. So if you look at all this, it means there's a risk in the Nigerian economy right now. Yes, at some point, you might see dollar will retreat. The issue of accessing $3 billion worth of loan from, they are short-term solution to a long-term problem. They are not solving that because the money you're supposed to use to throw up reserve, you are now using them to pay back. Then what happened? Our reserve is going down. So that's a topic for another day. But the whole idea is that the problem behind rate hike, rate increase, exchange rate increase, they are still there. So in the long run, I am extremely bullish when it comes to dollar. Until government comes up with policy that looks sustainable, then until then, for at least we have seen the long run is still there. So what am I saying in essence? Exchange rate is a big problem. So what are we supposed to do? I am looking for stock that have declared good results in Q1, Q2, and then their fundamentals is lifted by exchange rate. So that's why I said stocks that are net long on USD assets or USD reserve are green zone. Look at First Bank results, over 200 billion. Why? Because they are net long on USD. Net long means by the time they convert the another equivalent of their foreign assets, foreign dollars, then that's going to give them all their lives gain. So it's very important for us to look at that. So what am I saying in essence? The stock I'm going to show us are stocks that are going to be lifted by exchange rate. So when other stocks are suffering, when other stocks are going down, these ones are benefiting from exchange rates. So meaning that there's higher tendency that these rates would also support their Q3 and end of the year. And if full year results eventually comes out better than the previous year, then we should be expecting higher dividend. And by that, insurance investors will start buying them. Then we can take advantage of capital appreciation that will follow through and sell them before closing dates. So that's the essence. So let me discuss the two strategies that I use to pick stocks. Now, the first one we're doing right now is this buy in October, September, and then when NGS is down, and then sell before closing date. That's the one I just discussed. Then the other method, which I share because we don't have much time, which I share with members of my community, is we look for fundamentally sound oversold stocks. Can you imagine that? Fundamentally sound oversold stocks that are emerging from the bottom. That means these stocks, they have good fundamentals. But what happened? They have been sold off because of profit takers. And when profit takers set in on a stock, no matter how sound their fundamentals are, they will go down. Now, they will go down to an extent where supply is exhausted. That means everybody has finished selling. At that point, we say the stock has found bottom. And the only way you can go is up, because stock will always go up, up, down, up, down. So the idea is to look for stocks with good fundamentals. When I say stock with good fundamentals, I'm not talking about, there are fundamentals for long-term investing. There is also fundamentals for short-term trading. They are not the same. If you want to trade stock, stop carrying out fundamental analysis as if you are investing in long term, like fair value calculation, PE ratio. Sincerely speaking, these are fundamental analysis for long-term investing. I see a lot of people use this fundamental analysis for long-term investing. For short-term trade, a stock you only want to hold for 3 to 4 months, and you're doing fair value calculation. It's wrong. You only do that for long-term investing. When you are trading a stock for short term, the only thing you need to do to carry out fundamental analysis is to look at quarterly growth. What's the quarterly growth year on year? What's the Q1 result this year or this quarter against last quarter from revenue, net income, and earnings per share? So when I carry this analysis, I share it out, I drop it and say, this stock had declared good results. Because short-term sentiment is 3 months, 6 months, we should be out of this company stock. So that's the second part. But like I said, we are actually, our focus is on the first part. So that's why I will not take my time on that one. So let's now go deeper into the stock of the day. What are the stocks that I'm recommending? We've talked about picking stocks in August, and we've talked about picking stocks with good Q1 results, second quarter results, and then we've talked about this stock being well supported, not just their fundamentals, but events, macroeconomic events, so that we don't buy them and tomorrow something will just happen. But we're looking at an event that is sticky, an event that is actually hot right now. This in short, before I launched this webinar, I went back to my analysis and I saw that it has even increased to 5. So let me say it's actually a bonus that will now have 5 rather than 4 stocks. These are the 4 stocks that I'm recommending, and I'm going to do a deeper search into this company stock. First one is AXA Mansard. First one is AXA Mansard. And so at the time I'm doing this recording, AXA Mansard dividend is 9%. Note, this is not what their current dividend yield is. We are looking at future dividends. So based on the future dividend expected, AXA Mansard dividend should be more than this. But let's hold on. Let's look at the fundamentals of each company. I want to establish something. So I'll look at the fundamentals. I'll look at that part of this stock, and then I will tell you my best area to buy them, and then where you should start loading them and what you should do. Remember, the holding period of this stock is between now and next year, but we're not jumping in immediately. Why are we not jumping immediately? Remember, I told us something. I said ASI right now is at the top. So any attempt for you to buy all this stock right now, you don't go in with all the money. You are going in big, because if the whole market tanks, then it means that we might actually have a huge bargain. That means their price will be lower than entry, and that means dividend offers will be higher. So because of the state of the market, it means that these dividend stocks are going to be on my watch list, and as the price goes down, I'll be accumulating them bit by bit. So let's look at each of the company's stock. So I'm going to NSE markets now. So let's look at listed companies. Like I told you, this is going to be practical. So I'm not showing you stock and then tell you to go buy without doing it deeper. One thing about me is that when I recommend a stock, I probe the company, and then I want to understand why. Why did the company results go bad? Why did this company declare good results? Because it is in that why that I'll be able to find out. That's where my learning is. So if a company declares results, many of us will just say net income went up by 30%, revenue, everything good. No. If you have watched my course on how to analyze insurance company, you will know that net income, earnings per share is not enough. So there are things you need to understand. So I'm trying to open AXA Mansard's financial statement. All right. All right. So let's go down. So this is AXA Mansard. So I'm going to open their Q2 result, which is, remember, Q2 is what we're looking at. This is AXA Mansard. So let's go down to AXA Mansard income statement. I want to expand it so we all see that. All right, fine. Now pay attention to these results. Please pay attention to this result. Let me look at that 3 months. Yes. This is So this is 3 months, April to June 2022, 2023 against 2022. Now, you will see that 2.4, 2.5, that's insurance service income. Now, pay attention to this. Look at net investment income. Overall, the result was okay. So if you go down to the bottom, you will see that profit went from 1.4 to 11. Note this point. Profit for the year from 1.4 to 11. I don't just take the profit hook, line, and sinker. I want to dig deeper. Where is it coming from? Where is it coming from? That it's important you do that. Now, you will see that net income 1.6 to 13.4. Now, interest income calculated using effective interest rates, that's money from interest, 1.4 to 1.6. Look at this part. Net gain or loss on financial asset at fair value went from 94 to 11.5 million. Can you see this? 94,000 to 11.5 million. What is this net gain on fair value? What exactly is it? Let me go to the half-year results. This is it here. Net gain, note 31. Note 31. Let's go back. Let's see what is that note 31. What is this huge? It was even a loss in 2022. It was even a loss. And then in 6 months, it's already 11.5. What exactly is that? Let's go to note 37. Note 31, sorry. Trying to check note 31. All right. This is note 31. Can you see? This is note 31 that went from 97 to 11.5. Look at it here. I see foreign exchange gain. Foreign exchange gain from 578 in 2022 to 11.1. Whoa. Foreign exchange gain. And we just talked about exchange rate as one of the biggest macro data. Foreign exchange gain. So if a company like this is being lifted by foreign exchange gain when other companies are suffering from the same foreign exchange gain, then I need to pay because I only want to be on the winning side of the markets. Everybody wants to be on the winning side of the markets. Now, if you look at their half-year results, you will see that this is 1.9. If I check full year 2022 for Mansard against half year 2023, which is 13, it's already on. I don't need any native doctor. I don't need anybody to tell me that Mansard is on track to beat previous full year. Because in the half year alone, 2020, they generated 13.1. And half year 2022, it was just 1.9. So do you need anybody to tell you that this company is on track? And Q2, Q3 is still pending. Q4 is still pending. Q3 and Q4, they are still pending. And on my watch list here, where I scan Mansard, look at Mansard. In 2022, Mansard paid 2.79 billion as dividend. 2.79 billion as dividend. And their current yield right now is 9.3. If Mansard is able to declare huge results like this of average of 14, 15 in 2023, are you telling me that Mansard will not pay out more than 2.7 billion as dividend, which means that the yield will most likely be more than 9.3? Because when you consider the profit they generated so far in half year, it means this company will most likely pay out more in 2023. So this is a good dividend stock. And I'm not just buying them because they have declared. Remember, I'm not relying on financial statement entirely, and I've been able to prove that. What is our major conviction? This company is benefiting from exchange rates. Don't rely on financial statements because it's historical. Look for something that would give you an idea of where the future is going to. That's what I'm looking for. Many of us are too attached to financial things. We will sit down, we are checking, only use financial statement to confirm if your analysis of that company based on macro events is working or not. Don't say, I want to learn, let me do projection. What's the cash flow projection? It's good for, that's what, leave those ones for long-term investor. Say financial statement is not good. They are okay. But these are for long term. I'm trading. Like I always tell them here, oh, we even play in the community. Trading is like dating, investment is like marriage. I'm not going to hold Mansard for a long time. I'm holding Mansard for it qualifies as a dividend growth stock that is well supported by fundamental. And these are the kind of companies that corporate investors are looking for. These are stocks that corporate investors are looking for. Good fundamentals, well supported. They are paying dividend and they have the potential. In short, I think my initial entry on Mansard was around two naira or thereabout. I've already mentioned Mansard initially as an explosive stock in my community. But here we're looking at Mansard. It's a dividend growth stock. So if we go back to check Mansard, this is Mansard. Now, this is technical. I've done my fundamental analysis. I've looked at macro data. Now I'm coming back to check Mansard on my chart. What's the state right now? I've drawn, for some of us that are conversant with technical, you see, I've drawn a trend line. And you can see how this stock is supporting the trend line. So as long as the stock is below the trend line, the sentiment is largely bearish. So what am I trying to do? It means that any attempt for Mansard to go lower is really good for me to accumulate, knowing fully well that I have this key level right here. Now, I also draw what I call key level. Key levels are levels that the market always supports in the last years. If you follow me and if you follow my analysis, when I talk about technical, I talk about key levels are areas, region that the market has always respected as far back as 10, 15, 20, 30 years. You can see right here how this 3.4 is an important key level. It was respected in 2021. You can see here. And then look at how price broke from that region. And then, so this is a key support. So if Mansard begins to go down in line with the overall market, remember, we said NSE All-Share Index is already at the point where we might see the market go down. And if it goes down, it means this stock might also go down in line. When the overall market is going down, forget the analysis you have carried out, your stock will be affected because the weight of the market would have because your stock constitutes, in short, is even your stock that make up the market. So if the stock goes down a little bit, it gives you access to buy in at it. And when you buy at the lower price, it means the yield on this stock will be a lot more higher. So for those that have seen this opportunity, they are accumulating Mansard bit by bit, bit by bit. Any attempt for Mansard to break out of this trend line, Mansard should rally higher. Mansard should rally higher. In short, I did something very, very interesting. And let me share that. What is the trailing 12 month of Mansard? 1.65. Now, I had to do what I call my fair value calculation using a risk-adjusted discount. If you invest in FGM bond of, I think, 10 years or thereabouts, it's around 13%, between 13% and 15%. Now, because of the fact that I'm investing in stock, I'm not doing a risk-free asset, I need to factor in my additional premium. So I like to do a premium of 10 to 12%. Now, 10% plus 13%, which is what I'll get if I invest in risk-free asset, that's like 23%. So let's go with it, adjusted discount of 25%. So if I do remember, trailing 12 months is 1.65. 1.65 divided by 0.25. It means that Mansard should be selling around 6.6 naira. Fair value. The fair value of Mansard should be 6.6 naira on average. So if I want to be fair, I could say Mansard should not trade anything less than 4 to 5 naira. Going by the fundamentals. So it's well supported by fundamentals. Economic trends also supporting Mansard. So that is one stock you should look at, Mansard. Then another stock, again, is custodian investments. Custodian investments. So let's go and check. Remember, we are looking for stock that are well supported by economic events and then get confirmation from financial statements. So let's look at custodian investments. These stocks that I'm telling you right now, from my analysis, they are already on track. That means they are trailing 12-month results from revenue to net income and earnings per share. They are already far above 2022 full year. That's what I mean by trailing 12. But that means if I add their last 4 quarterly results, it's already more than full year 2022. So this is custodian investments. So let's look at their Q2 results. Now, you would also notice something on custodian investments. Let me look at their. All right, so I'm going to expand this so you can see very well. I'll be a little bit faster. Now, look at custodian investments again. You would see again, if you look at our financial statements, profits 2.44. Now, despite the fact that we had a little, you can see under net income, because of increase in change in provision of outstanding claim, you can see right here, it's normal for an insurance company to pay out claim. It's normal. So, but these guys paid out more. So it went from 3.3 billion to 3.1 to 14. So because of that, it dragged their net income from 7.4 to 1.1. But guess what? Their result was well supported. Look at net fair value gain on loss. From a loss of 2.3 to a profit of 7.8. Note 33. Let's look at note 33. Let's look at note 33. Yes. So let me check the notes again for confirmation. I think I'm missing out on something here. Oh, I think there's a mix up here. Net fair value gain or loss to net realized gain or loss 1.3. Sorry, I need to put custodian on hold. I think I'm missing out on something because this is net realized gain. So note 34. So 1.3 to so I need to put custodian on hold. So let me go back. Note 34. Okay, net realized gain on foreign exchange. Sorry, custodian on hold. I need to look at that, please. So this was not a market red. Then I'll mark custodian red. So leave custodian for now. Now look at GTB. GTB. Now GTB result is not yet out. It's not yet out. Now GTB and Access Bank. I think a lot of banks are well supported because if you go by the result of First Bank results, it already tells me that most of the banking stocks that are net, not all banking stocks are net long on their USD assets. So because of that, I only focus on few banks. So GTB and Access are stocks I'm also buying because of that. So I'm buying GTB and Access, although the result is not yet out, but because of the result of First Bank. Now, let's look at Lasaco Insurance. Lasaco Insurance. Lasaco Insurance. I think I checked this. Lasaco Insurance. Lasaco Insurance. All right, so this is Lasaco. Let me increase it. Okay. So this is Lasaco, April to June. You can see the results here. Okay, so underwriting income, next premium end from 6th. Then you see one thing here. Let me go back. So, trying to get this. So you see that profit after tax from 74 to 195, profit before tax 78 to 204. Now, where is the boost coming from? Other income. Other income, which is note 29. Other income, note 29. Note 29, other income. So you can see right here, other operating income, gain on foreign exchange transaction, gain on foreign exchange transaction, 374 to 402, 374 to 402, gain on foreign exchange transaction. And if you check their, if you check their Q2 results, half year, you can see right here, half year, 8.8 to 10, then 407 to 545. Profit after tax, you can see earnings per share 0.05 to 0.27. Now, I already have a video on how to analyze insurance company. So when you're analyzing an insurance company, don't just jump on profit before tax. Understand the business of insurance. It's what we call combined ratio. Know the combined ratio of an insurance company. Combined ratio is when you compare how much an insurance company has paid out from the premium it has collected. If an insurance company is paying out more premium, paying out more claim and underwriting expenses compared to what it has collected, then it's a loss-making insurance company. So don't just assume that profit before tax is positive, profit after tax is positive. What if the insurance company is using other investment income or sales of assets to cover up its account? So make sure the company is able to generate enough premium. This is what I mean. Let me just do a recap. Now, when you're analyzing an insurance company, pay attention to this net insurance premium end. The three things you should look at is net insurance premium end, number one, net claims paid, and underwriting expenses. If this insurance company collected 1.95 billion, and out of the 1.95 billion, it's paid out 420 and then 1.3. If you add these two together, 1.7. If this 1.7 is less than 1.9, then it means it's profitable. That means it collected more than it paid out. No insurance company wants to be paying more than it's collecting. Like here, you can see 5.5, 6.2. So meaning that it's collecting more than it paid out. So assuming claim is 2.5, and then 2.5 plus 1.3 is giving you 3 point something, and then net premium is 1.9. That's the red flag. Even if the insurance company declares profits, there is already a red flag right here. So learn to detect the red flag. So one of the most profitable penny stocks in the market is insurance. But many of us jump on insurance company without understanding this little thing I just showed you. So make sure you buy only profitable insurance stock. Make sure you buy only profitable insurance stock. Now, if I go to the charts of Lasaco, now if you go to the chart of Lasaco, you will see how Lasaco, we can see how Lasaco respected this key level. Can you see? That's the importance of drawing key level. After the huge rally, you respected this key level at 2.5 before pullback. Before it pull back, and you can see the next key level right here. So if, let me join, I have another one here. So if the market eventually comes down, these are the kind of stocks I am going to buy. Why? Because this company, they have history of paying dividends. And then knowing fully well that higher profits would always be equal to higher dividends. Especially company that has history of paying higher dividend. So here I'm looking at AXA Mansard, GTCO, Access Bank, and Lasaco. AXA Mansard, GTCO, Access Bank, and Lasaco. Now I'm waiting for GT Bank results and Access Bank result. The reason I am bullish on these two is because I feel that they will benefit from the exchange rate, number one, and then number two, these ones are staple dividend companies. If you want to find the best dividend, that's why banks are more liquid. So Access Bank, GTB, and Lasaco, and also AXA Mansard. Now look at the sector. What's the sector? Insurance and banking sector. These are the sectors, these are the hottest sector right now in Nigerian stock markets. Insurance and banking sector. They're the hottest sector, and these are sectors that are benefiting from exchange rate. Not like other sectors are not good. Not like oil and gas is not good or thereabouts. But I'm looking at a sector that will most likely be lifted. Because even the oil and gas firm, the downstream company, are even talking to government to find a way to reduce fuel price. Because they are also being affected. A lot of petrol stations now are reporting lower sales. When insurance company collects premium is like free money. If you're able to do your job very well, what do? You invest that premium in financial instruments. Some of them invest in US dollar denominated assets. Some of them invest in their dollar reserve. That's why they are being boosted. So AXA Mansard, GTCO, Access Bank, and Lasaco are my top 4 pick. There are 4 dividend growth stock to watch. So if NSE market is going down bit by bit, these are the companies I'll be accumulating for capital appreciation against next year. What am I doing? I'm trying to get in early. I'm trying to get in early before others. I'm trying to get in early before others. So it's important you understand this concept in the market, and you would only find the best stock around this time when you follow this rule. If I show you my screen now, this is what I've done. I have my revenue, I have my net income, and then I have my earnings per share. So look at this. What is revenue TTM? TTM is trailing 12 months. That means when you add the revenue generated in the last 4 quarters, that's what TTM is. Now, the current quarter, quarterly growth year on year, that means the current quarter against the previous quarter. You can see here. Then, when you generate money, it must definitely translate to net income. If you're not making profit, I'm not buying. So, net income in the last 4 quarters, current quarterly net income growth, then earnings per share. It's from earnings per share that the company pays dividend. It's from the earnings per share that the company pays dividend. Now look at Mansard. Among this company, the hottest of them all is Mansard. Look at Mansard, 29%, 29%. Net income, 777%. It means this company last 4 quarters is already 774% more than previous year. Look at 774. Look at net income in current quarter, 2,396%. Look at earnings per share. If dividend is paid from earnings per share, and earnings per share is already up by 771%, and these guys paid 2.7 billion in 2022, how much do you think they will pay in 2023? At least, if I want to be fair, I will say Mansard might pay up to 4 billion. Between 3.5 to 4 billion by estimates. And then they pay dividend of, you can see here, 0.36 kobo. So if this dividend now moves from 36 kobo, let me assume that they pay up to 50 kobo per share. 50 kobo, and what's the current share price of AXA Mansard? 3.8. So 50 kobo. You see here, that's almost 13% dividend yield. That's estimate. Currently, you're saying this 9.3 you're seeing here is based on what they paid last year. So my estimate is that if Mansard pays up to 50 kobo per share at current market price of 3.8, that means you'll be collecting 13%. So if NSE market dips and this company stock comes down maybe like 3.5, for instance, 3.5, 3.4, then it means this dividend yield might actually be up to 14. So if it comes to 3.5, so Mansard has a potential 14% dividend. That means it's going to be one of the best dividend growth stock in the market. So see opportunities ahead, get in early before others, and exercise patience. You actually make more money by exercising patience in the market. You make more money by exercising patience in the market. You can see Lasaco, 160%, 64%. So how much does Lasaco pay out as dividend? 15 kobo. So if Lasaco increase dividend, it's going to be higher. So, but the hottest of them, the best of them for me is Mansard. Let me wait for GTB and Access Bank to release their results. Then I can do my further analysis to confirm. But for now, Mansard is the top, then Lasaco. But before I buy this company, I want them to come down at key level. You can see here. So even though I'm going to buy them because dividend yield is very high, or I think they will pay dividend, I still would not want to get in immediately. I want to buy them at key level so that I'll be able to get in cheap. And if this stock still goes down, I will buy. Why? Because fundamentals are well supported. It's not compulsory that you must buy all, but the essence of this analysis is to give you the option of choosing the one you want to buy, but still helping you to understand that my pick are actually based on macroeconomic data and not entirely financial statements. So I would strongly advise some of us that are joining for the first time. So please, I have other courses I may not want to touch right now. I have other courses that would help you improve your trading. For existing members that are yet to watch, please go. And those that have watched it, at least I'm glad many of them have given me feedback on how their investment decisions have changed completely, especially when you go check beginner to dividend income course. If you want to invest in the Nigerian stock market and you're looking for the best dividend stocks, I have a course on beginner to dividend income. I have a course on millionaire stock trader. Now, this one I talked about trading 12 months. I took my time to explain it here. How to analyze the stock for short-term trading. It's not the same as long-term. What in the few numbers, when you're trading a stock, you don't need to spend time trying to do fair value calculation, future cash flow. No, you just need to check few things. Trading is 90% technical and then 10% fundamental. Investment is 90% fundamental and 10% technical. You will see them under this place. Then I thought, then for beginners, people that are starting for the first time, stock market for beginners course. Then I also talked about how to analyze insurance company. You will find it here because here I know insurance is different. Insurance is not like any other kind of company. So many people have assumed that the same way you analyze an insurance company, you analyze a manufacturing company, maybe Dangote Cement or Sugar. That's how you analyze an insurance company. No, insurance company is different entirely. If you miss it, you might end up buying to the wrong company. That's why a lot of insurance companies are selling at a cheap price. Many of them are selling at a cheap price. Why? Because their fundamentals are not solid. So how do you know the best one to buy? How to analyze insurance company will help you. NEM, at some point, was selling for below 1 naira 50 kobo thereabouts. So this will help you know the best. Look at a lot of insurance companies have went up. Look at Consolidated Hallmark Insurance. Look at Asako. Many of them went, you can see here, at the beginning of the year, They were all selling for 90 kobo and to 2 naira. Why? Because there are certain things in their fundamentals that you need to watch out for. Then how to protect your capital as a trader. This is very key. You don't just jump in at every point in time, because the number one rule is preserve your capital. So if you don't know how to preserve your capital, this will help you. And one of the ways to preserve your capital is to know when to get into stock and when to get out. Don't always be in the market every time thinking we are here, I must make profit. No. Know the best time to go big, know the best time to reduce your exposure, and know the best time to stay off the market completely. Capital preservation, because if you lose your capital, what else are you going to be trading with? Nothing. And I already have this. All of them are all free for people that join my community. I've taken my time to record this video for people that join my community. Very soon, I'll be launching a mobile app. Very soon, we're almost 80% done. So that would make it more easier for everybody to be able to watch these courses. So for people that join my community, all these courses are free. But once you join the community, you have access to these courses. So imagine watching all this. It will improve. With the few ones that I've shared so far, I'm sure you've gained a lot. Now imagine that you're able to, it will help you improve. And I always advise them, stop mixing all your stocks together. At least open 2 brokerage accounts, one for trading, one for investing. The one for trading is where you do all this analysis. You buy this for capital appreciation, because a lot of people, when they send their portfolio to me and I see that you are combining stocks that you should hold for trading with stocks you should hold for investing, it will be difficult for me to tell you whether you're doing well or not. Because when you buy a stock for investing, the least thing you should be bothered about is price. In short, if price goes down, you buy more. Because the more you buy, the larger the quantity, the larger your units, the higher your dividend. So you don't mix stocks that you're supposed to own for dividend or cash flow with the one you're supposed to buy for trading. It will not, your portfolio will not it will not represent the true value, or in short, the performance of your portfolio will be distorting. But when you show me a portfolio with stocks you have bought for dividend and you're down by 10%, then we can know where the problem is coming from. If you show me portfolio with dividend and you're down, I won't be bothered. Especially if the stocks are giving, if the companies are giving you money or they are paying you dividend at the end of the year. Because the reason you bought them, you didn't buy them for capital appreciation. You bought them for cash flow. So those are some of the things I share. Separate your trading account from, and we have good brokers. There are a lot of brokers out there that you can open 2 accounts. I operate Investment One and Meristem. I use Investment One for investing. I use Meristem for trading. Other members have Morgan Capital. Others use there are many of them. There's Atlas Portfolio. Some use AfriInvest. Some use even Yocha. Some say they have good experience with Yocha. There are many brokerage accounts. Open 2, open 3. Let one be for investing, so that when the market is down, like I showed you right here, if the market is down, what do? You go to your investment account and start buying more stock. Because you know that when the market is down, that's the best time to load stock at a cheap price. Imagine that you could buy Zenith Bank when Zenith Bank was selling for as low as 11 to 12 naira. Look at it here in 2020. So when Zenith Bank was crashing, if you had bought for trading, you will lose. But those that have the eye of investing would have mopped up Zenith Bank at this point. Imagine someone that mopped up Zenith Bank at 11 naira and Zenith Bank is selling for 32. Compare what the dividend would be like. So you need to know how to manage both your investment and your trading accounts. It's important. So I want to stop this video right now and then give room for question before we can wrap up. So let me